the question about the high-tech stocks and possible fallout, anytime there have been real bursts of speculation in the market, it does get corrected eventually. Ben Graham was right when he said that in the short run it's a voting machine, in the long run it's a weighing machine. Sooner or later, the amount of cash that a business can disgorge in the future governs the value it has, that the stock commands in the market. But it can take a long time.
First, more on our top story. NASDAQ 5,000, America's favorite stock index, closed above 5K for the first time today.
Priceline.com is the latest beneficiary of the internet stock craze. Shares of the internet commerce company debuted at $16. They closed at $69, a rise of over 330%.
Earth Web was up 379%, and the Globe.com, which only traded one day, gained 606% on the week.
In tonight's Moneyline Movers, cash flow up 102 3/8 in its stock market debut. The networking equipment maker enjoyed one of the best opening days ever. The stock trading at 5 times its offering price.
Akamai is Hawaiian for cool. Technology company soared more than 450%. The stock that stole the show today is called Free Market. Public today selling shares to the public, and take a look at what this stock did, up 482% or so.
Kind of valuations that were going on and the kind of trading that was happening in public markets, it's really fueled by what you would call the greater fool theory. In other words, there has to be a greater fool than you that buys it, or the whole thing collapses. Well, ultimately, you run out of greater fools.
After what they are already calling Black Friday, they are counting up the damage on Wall Street tonight.
In the spring of 2000, the stampede reversed.
And sent the Dow and the NASDAQ plummeting. It was the worst single-day point loss ever for both exchanges.
We start off with that tech-led sell-off on Wall Street. The Nasdaq sinking over 2.5%, ending the day just shy of its lowest close of the year. And with just one trading day left in Q1, the index is pacing for its worst quarter in nearly 3 years. Every member of the so-called Magnificent Seven was down today, the group losing a combined value of over $500 billion in today's session alone. The S&P Dow and small cap Russell 2000 also sharply lower today, and in March, all firmly down on the year as well. The catalyst behind today's action, more hot inflation data. The Fed's preferred measure of prices coming in slightly above estimates, and the University of Michigan's long-term inflation expectations hitting a 32-year high.
In the end, valuation does count, but it can go on a long time. And when you get a huge number of participants playing with ever increasing sums, it creates its own apparent truth can be for a very considerable period of time. It doesn't go on forever, and whether it has fallout to the whole economy, like it probably did in the late 20s, or whether it's just an isolated industry or sector where the bubble bursts and it really doesn't affect other values, who knows? But 5 or 10 years from now, you will know. Charlie?
Well, I think the reason we use the phrase wretched excess is that there are wretched consequences. If you mix the mathematics of the chain letter or the Ponzi scheme with some legitimate development, like the development of the internet, you are mixing something which is wretched and irrational and has bad consequences with something that has very good consequences. But if you mix raisins with turds, they're still turds.
All right. Today is Sunday, the 30th of March, and this is a recap for the stock market activities for the week that was and an outlook for the week to come. And folks, I got a good one for you tonight. Now, before we begin the program, condolences to everybody in Myanmar and Thailand. I know we have a lot of viewers in Thailand, expats living there, so my heart goes out to you, and I hope you're safe and sound and secure. And a happy holiday to all of our Muslim viewers across the world. I hope it brings you the best of health and wealth, my friends. But let's begin right here what inspired this video. There was a seminar here for retail investors, and it kind of sparked my curiosity to at least just attend. I didn't speak or anything, I just attended like everybody else. And I wanted to know what's going on right now in the minds of these retail investors, all ages, all shapes, all kinds, all over the place. But the majority, of course, joined the market, let's say, within the last 4 to 5 years. And I saw a lot of complaining. I saw a lot of negative sentiment. I saw a lot of kind of panicky and fear kind of behavior, where folks are saying, what's going on here? Like, I look at my portfolio every day and it keeps going down. It keeps going down with no stop. The stocks that were going higher, doing pretty good in my portfolio now, were just going down like crazy. Now, what do we do here? Do we buy in the dip? Do we sell? Do we exit? What do we do here? And I thought, what if I was a speaker today? What would I say to all of these folks? And I came up with the idea of this video, which is pretty much in a nutshell. You have seen the voting machine. You're probably now beginning to witness the weighing machine. And this is, of course, one of the principles of perhaps one of the best, if not the best, investing books of all time, Ben Graham, which, of course, the donkeys today are posting the memes. They're throwing the book in the garbage, as in valuations don't matter. Fast forward a few months later, they probably want to do some dumpster diving and grab the book again, because you've experienced the voting machine, as many previous generations, by the way, have experienced, either in the dot-com bubble or in the 80s or in the housing mania. Everybody experienced that, and of course, when we have a bubble or a mania, it attracts a lot of retail investors, and that becomes the first experience, the voting machine. But then when we see the shift to the weighing machine, they're confused and they end up being the victims of the rise and fall of whatever bubble it is. So my goal in this video is, let's say, to reduce the number of victims, because at the end of the day, most of them are not going to listen. Most of them are just accustomed to the recency bias, and they're going to assume that what happened the last few months will happen again. Stocks go down, they're going to come back up, valuations don't matter, etc., etc. But at least some will listen, and that's good enough to me. So let's begin here, folks, and dive right into it. When we talk about the lessons from the dot-com, was I a participant at some point when I was younger and more naive in a voting machine? Sure. It was the dot-com bubble as an example. But once the bubble goes kaput, the problem is it could take a long, long time before you're able to recoup your investment, if ever. And of course, as you wait to recoup your investment, other investing opportunities are ongoing, and you're missing out on them. And this is why I disagree when folks say, oh, timing the market beats timing the market. You always have to time the market, especially when the evidence and the signs are clear. Because at the end of the day, believe it or not, life is transitory. And what you're looking at right now here is the Qs, the NASDAQ ETF. This is the monthly chart. You can see since the top of the year 2000, the dot-com bubble. It took all the way till 2016 before reaching the same highs. The same period of time, there was many investing opportunities. There were booms and busts. And the hope here, of course, is you don't want to be like some of the folks who bought at the top of the dot-com bubble and continued to buy and average down as the index went down, believing that it's just a temporary pullback or giving you a sale or whatever, only to realize that they've been digging their grave deeper. Of course, that happens usually too late, so we're trying to prevent all of that. And by the way, it's not just the speculative IPOs that were the problem. It's also high-quality companies. If you go back to the quote from Charlie Munger, if you mix turds with raisins, they're still turds. And some would say, okay, but Mav, in the bubble that we have right now, we don't have the crazy IPOs. We have high-quality stocks, real companies that are leading the bubble. My counter to that, of course, if you look at the last, let's say, few months, we've seen insane surges in stocks of companies that uttered the letters AI without proving or providing any evidence that they have real participation in AI. So yes, we have a lot of similarities between now and the dot-com. But even when we talk about mixing raisins and turds, when you have a good company, a high-quality company, be it NVIDIA, be it whatever, and then you mix with that bad valuation and excess speculation, you're mixing turds and raisins. I remember back in the dot-com, and this is quite personal because I did get hit in this stock right here. It's called Akamai. You can see that it debuted late in the dot-com. Lots of us chased, only for the stock to crash and never recover. There was a lot of hype back then about this stock. And it's still a great company, by the way. It's still here. But it's just never going to live to the hype and the valuation it began trading at back in the dot-com bubble. You see other high-quality companies like Cisco. That stock has never recovered the dot-com peak. Is it a bad company? No, of course not. But the valuations did not make sense. Same thing with Intel. Never recovered the dot-com highs. You see stocks like MicroStrategy. Big hype and boom during the dot-com, only to be met with a massive crash that lasted for decades. And now, of course, the founder of that company found a new generation of donkeys to scam. And this time around, of course, using Bitcoin. Recently, he suggested to sell a kidney if you must to keep buying Bitcoin. Now, please, if you want to sell your kidneys, just leave a comment in the section below, and I'm going to reach out to you with some of my Mexican cartel connections. We can arrange that. They'll pay top dollar for your kidney. Might as well sell your brain while you're at it, because you don't need one of those. But here's the trap. The trap for anybody who, let's say, joined the market recently, the last 4 to 5 years. They will look at some of the wreckage that's going on in the market right now and say, but, look at what happened to Meta. The stock crashed, lost trillions in value. In the year 22, only to come back better, stronger, and trading at higher highs. And by the way, Meta already topped, so if you bought it, made a lot of money, congratulations. It's time to sell and book your profits right now. But folks, we'll look at another stock like Netflix, for example. It crashed in 22, and it was a great buying opportunity because it came back with better gains, surpassing the peak before the crash. By the way, another stock that topped, so if you made money, please book your profits. What is the difference between, let's say, the drops that we've seen in Meta and Netflix in 22 and why they came back versus what happens in the weighing machine? Two different things. The problem in 22 in the majority of the big technology companies, including Meta and Netflix, was that they were spending a lot, and that was hurting the profitability of these companies. So investors, of course, when you have the Fed hiking rates and you have a lot of questions and uncertainty about the economy at that point, they see a company that is spending like a drunken sailor and not really considering profitability anymore, they exit, and they exit en masse. So we see these huge drops, but then, of course, both companies, be it Meta or Netflix, corrected course, cut a lot of spending, profitability improved, and these stocks recovered and then some. If we are in the weighing machine, though, it ain't going to work out the same way because this is something companies, individual companies, cannot fix. What we have right now is two problems. Fundamental change in the economy with the stagflation phenomenon, which, by the way, handicaps the Fed from being able to fix anything. And number two, the change in psychology. Of course, the change in psychology will influence the outcome of the economy sooner than later. And what we see right now is much, much worse than 22. It's more inclusive, and we talked about that in details over the week. But I want to share some of the differences in mentality that all retail investors have to understand, adapt to, and apply in their investing and trading journey. Because the approach when we have a voting machine is quite different than when we have a weighing machine. Now, I know I misspelled weighing machine here, so take it easy in the comment section and focus on what really matters. What really matters is the difference between the two. So we begin with valuations. Under the voting machine, valuations don't matter. Under the weighing machine, valuations do matter. Sounds easy, simple, and common sense. So how do we use that to adapt the strategy in our investing and trading? You look at the top performers in the S&P 524, that's your voting machine. Palantir is on top, which is, by the way, a Ponzi scheme, a marketing Ponzi scheme. The valuation doesn't make sense at all, but of course there's a stampede. Palantir spent a lot of money to get these influencers and YouTubers and folks on social media to hype the stock, to get more and more buying money so they can dump and get richer. But again, under the voting machine, that's what really matters. If we have more buyers than sellers, the stock will go higher, defying all valuation metrics, where valuations don't matter anymore. And Palantir, at least still is, one of the most absurd cases of overvaluation in stock market history. But you see other performers here like Vestra, Nvidia, United Airlines. Let's see how some of these are performing so far. So if you look at Palantir, top to the most recent bottom, down about 40%. Again, it was one of the top performers in 24, but now already down about 40% from the peak to the recent bottom, which looks like we're going to take it out and head lower, because if you look at the chart, it is perhaps showing a topping head and shoulder pattern. You see a lot of them here showing similar patterns, but one step at a time. One thing to really help you out, if you're a retail investor, let's say you joined the market in the last few years and you've been bullish and chasing the hype and it's been working out for you. Your mind is programmed to look at charts in a certain way. So one great exercise you can do, you're looking right now at the chart of Palantir, weekly chart. Looks pretty good, right? It looks like it went all the way crazy, pulled back a little bit, might continue to go higher, right? But here's what you gotta do. Flip the chart upside down and look at it here. It looks like we had a crash, right? And now we're forming sort of a higher low. And once we pass the previous resistance zone, then the bottom is already in. And higher we go from this point on. This is what your brain, what your eyes are trained to see. As a retail investor who's a new participant, relatively speaking, in the stock market and programmed to look at the market from the perspective of the voting machine. Once again, is it a chart that you would buy right here? I don't know. I mean, you look at the SPX, the crash of the pandemic, similar pattern, right? You have a higher low after the crash. Once you pass the resistance zone, up to the races. So just by flipping the chart, you would buy that chart. In other words, looking at the chart as it is right now, you're probably going to sell or short that chart. And this is why we've shorted Palantir in the Maverick portfolio this year. So I want you to do this exercise. Flip the charts upside down and ask yourself whether you're going to be a buyer of this chart or not. And if the answer is yes, then go back to reality, and the real answer would be I'd be a seller or a short in this chart. You look at Vestra, VST, top performer last year. So far this year, top to the recent bottom, down over 45%. And once again, the dreaded head and shoulder top pattern, which if you flip the chart upside down would look as an inverse bottoming head and shoulder. You look at UAL, United Airlines, one of the top performers last year, as if United Airlines is an AI company, of course. What happened this year? Top to the recent bottom, down over 40%. And it looks like there's more to come. Another hot stock last year is Robinhood. But what happened so far this year? Top to the recent bottom, down over 45%. And unfortunately, in that seminar that I attended, I heard a lot of folks saying, oh, you got to buy the dip in Robinhood because this is your buying opportunity. It's going to continue to go higher. And I wanted to interfere and say, well, wait a minute, why would it go higher? If we see the market going down, if we see retail investors losing money, we will see less participation in Robinhood. To me, that's a sell. That's not a buy. But of course, to each his own, so they didn't say nothing here. But if you look at Robinhood, same thing. It's probably a topping head and shoulder pattern. One of the top performers last year is a stock called AppLovin, APP. Huge rally last year. This year, so far, top to the recent bottom, down over 55%. It looks once again that it is in the process of forming a topping head and shoulder pattern. You got HIMS, one of the most popular retail investor stocks. One of the top performers last year. This year, top to bottom, at least the recent bottom that we've seen so far, the stock is down about 60%. We've made a short video here on my channel on YouTube showing that I did participate in the rise of the stock HIMS. We made a lot of money from it last year all the way to this year, but then had to sell it because it stopped making sense. And in that video, I kind of hinted that the top is already in. And guess what? It was exactly the top. So go watch that short. But this is, again, the voting machine shifting toward the weighing machine. A lot of folks will make the fallacy of, oh, but it is a buying opportunity now. Not if we're shifting toward the weighing machine. The craze is over in that case. You look at HIMS, once again, could be forming the dreaded topping head and shoulder formation. Perhaps one of the most absurd cases of overvaluation is the stock Tesla, TSLA, aka the souffle. It's a trash stock. It lives up to the new design of the Cybertruck. It looks like a trash can. If that was not a hint, I don't know what would be. But you see that Tesla was moving higher after the elections just based on, Trump is going to be good for Elon. Elon is going to be good for Trump, and you got to buy Tesla because of that. And everybody's stampeding and buying this shit without really considering the valuation or whether it makes sense or not. When the company already showed you that they're not producing any profits, they're losing money. Well, that was the voting machine. Here comes the weighing machine, and the stock is down, top to the recent bottom, over 50%. And I think there is more to come. And once again, you got your dreaded topping head and shoulder formation. And it goes on, folks. I mean, you have a stock that didn't make sense throughout all of these years, like ANF, Abercrombie and Fitch. I mean, what is this, the 90s? Didn't make sense at all. That was the voting machine, though. Weighing machine so far, top to the most recent bottom. Stock is down over 60%. So that's a huge difference, and you've seen it before. Not back in the dot-com, just go back in the pandemic. The Zooms of the world, all of these pandemic stocks like Teladoc, all of these stocks crashed and never came back. So you always have to ask yourself the question, when you see drops like we've seen in the market recently? Is the voting machine over? Because if the voting machine is alive, then you'll see a recovery again. But if the voting machine is dead and we're shifting toward the weighing machine, then you have to shift your mentality in looking at these stocks and the valuations in the market. And every day we cover the signs, and I'll remind you again before the end of the video about all of the signs and the videos that we made in the last few weeks, last few months, preparing everybody for this outcome. Now let's go back to the board. In the voting machine, we have an upward trend in the market. In the weighing machine, we have a downward trend. Now you might say, Maverick, duh, this is so obvious, but do you know how to deal with it? Do you know how to trade it? How to invest in it? Probably not. So I'm going to help you out here. What we're looking at right now is the SPX, the S&P 500, a weekly chart. I've been teaching this going back, let's say, months ago, that the wave is going to end. The wave, the wave, the wave. Nobody wanted to believe me back then, but here it is. You look at the MACD weekly wave. When you have a crossing above the zero line, that's the birth of a bullish trend. And specifically when you see the average, so the white line in the chart is the MACD. The blue line is the average. When the average crosses above zero, that's your signal that we're now shifting toward a bullish trend. And it could last for a while. But once we see the trend shifting back to negative, as in crossing below the zero line, that's the official beginning of a bearish wave. We've seen the same thing after 22. We've seen the MACD indicator in the weekly chart crossing above the zero line, and that was the birth of a new bullish wave. What are we seeing right now? We're seeing perhaps really similar to the year 22, when the MACD indicator in the weekly chart crossed below zero. That's your bearish wave, aka the bear market. And of course, the 50 weeks moving average will help you out as a confirmation. Trading above the 50 weeks, you got a bullish wave. Trading below the 50 weeks, you got a bearish wave. A lot of folks want to use the 200 days moving average as an indicator. That's good. But what's better is the 50 weeks moving average. How do we deal with a bullish trend? How do we invest? How do we trade? You stay long. You have a long portfolio. You stay long. You continue to buy calls. But once you see the weekly chart getting overbought, as I'm highlighting in the RSI, you begin to hedge. You can hedge using put options for a week or two, a month. That's going to do the job. And you use the dips so long as we're above the trend as an opportunity to continue to buy. And your trend is either the trend line, but better yet, once again, the 50 weeks moving average. If we're not losing the 50 weeks moving average, it's okay. You can buy the dip and higher we go again. The other warning sign you have to look at is the negative divergence in the weekly RSI. When you see that, you need to begin not only hedge, but to begin to book profits too. And of course, when we go down and we take the 50 weeks moving average as we've done recently, you have to begin shifting your strategies from a bull wave strategy to a bear wave strategy. So how do we deal with the market in a bear wave strategy? Let's go back to 22. Now we have a trend of resistance. We retouch and retag that trend over and over and over again. Of course, as in the support trend in a bullish wave, producing dip buying opportunities. In a bear wave, retagging the trend line is a fade the rip opportunity, aka you short at these touches. So long as we're below the zero line in the MACD, so long as we're below the 50 weeks moving average, you continue to short. Likewise, if we shift to the 4 hours chart, when the RSI indicator, the relative strength indicator, becomes absurdly oversold, as in you're getting now to the lower boundaries of the indicator, that's of course a hedging opportunity. And you hedge via buying calls for a couple of weeks, a month, just to account for a rebound play, but you stay short and you add to your short once the chart retags the trend line. So now you know how to deal with the market in a voting machine upward trend or in a weighing machine downward trend. What else do we have in the board? In the voting machine, the dumb sounds smart, but the smart sounds dumb. So the folks who were bringing up all of these indicators, let's say in 24 or 23, and pointing out that, hey, this is going to crash, it's behaving as a market bubble, not as a usual, let's say, garden variety bull market. That's the smart. They're showing actual pieces of data and analysis to back up their conclusions. But they sound dumb because the market keeps going higher. And likewise, the dumb. Anybody who just opened a social media account following the hype, any YouTuber saying, oh, you buy the stock and you'll be a millionaire next year. And it keeps working. Hence, the dumb sounds smart. But in a weighing machine, the smart sounds smart again, and the dumb sound dumb again. And that's not just in social media or on YouTube or at the retail investor level, even at the professional level. If you go back to the dot-com bubble, we had Henry Blodgett, who correctly, of course, called the rise or the pop in the stock Amazon And after that, everybody was following him. What is going to be the next Amazon? And fast forward, of course, his fund blew up. He got sued and charged with fraud by the SEC. Later on, of course, he redeemed himself by being a mouthpiece for the CIA, and he made a lot of money from Business Insider. Some of the folks who sound really smart in the last few years is somebody like Tom Lee from Fraudstart. And again, we're all familiar about his calls back before the crash in 08 and 09, so nothing new for us here, but for the new generation of donkeys, they think he's a prophet or something. All what he's doing is just calling that the sun is going to come out from the east every day. And most recently saying that we're going to see a face-ripping stock market rally. The only ripped face that I see is Tom Lee's. So again, smart is sounding smart again. The dumb is sounding dumb again. We go back to the board. What other differences that we see? In the voting machine, we have chase the momentum. That's your strategy. Doesn't matter. Valuations don't matter. Chase the momentum. Chase the hype. Chase what makes sense at that moment. So you've seen technology stocks moving higher. Valuations didn't matter. Meme stocks went higher. Anything that was popular on social media went higher because that's what you do. You chase the momentum. In the weighing machine, though, you short the momentum and you play defense. What does playing defense mean? You got to change your portfolio strategies. You got to buy the boring stocks, the decent valuation kind of stocks that produce a lot of cash flow, the kind of stocks that were not appreciated under the voting machine. And it ties up with the next point, which is I've been hammering to my members and viewers for a while now. In the voting machine, of course, if you bought NVIDIA or you bought Amazon, you've outperformed the market. If all in NVIDIA, all in Amazon, all in whatever of these stocks that went significantly higher, you've outperformed the S&P 500. But for most investors, we have the voting machine. For most investors, once they become active managers of their portfolios and pick individual names, they end up screwing up. They get good picks like NVIDIA, but then they get shitty picks, and all in all, they end up either outperforming the index by a little bit or lagging behind the index. So for most investors, not all, but for most investors, buying ETFs is easier and makes sense than being an active manager buying individual stocks. In the weighing machine, though, ETFs don't make sense anymore because you're lumping the turds and the raisins. So you gotta pick the individual stocks. And the evidence is right here. What you're looking at, of course, is the market's 3-month performance heat map. You can see that the stagflation portfolio that we outlaid for all of our viewers are doing pretty good. So you see stocks, for example, like Alibaba up 50% for the year. You see stocks like AT&T up over 22% for the year. You look at a stock like Amgen Healthcare up over 16% for the year. You look at Philip Morris up over 20% for the year. Berkshire Hathaway, your boy Buffett, is up about 15% in the 3-month period, which is almost year to date. But you see wreckage in Tesla down over 42% in Google and Amazon and Nvidia. So when folks say that the entirety of the market is underperforming and there's no place to buy, there's no place to hide, that's baloney. But you see it in the individual names. Now go to the 3-month heat map for the ETFs, and you'll see that you have limited choices. Even if you bought, let's say, the XLP staples or the XLU utilities, you're up about 1 to 2%, which is not much. If you bought the value ETF, VTV, you're still down. If you bought the dividend ETF, the Charles Schwab, which is really popular, and if you must stay long the market as in a retirement portfolio, it is your best choice, but the SCHD, it is flat for the year, and the rest, of course, is down. The only outperformer is the XLE Energy, up about 9% so far. But then what? The stuff that went higher is either international ETFs, like China, Europe, or gold ETFs, like GLD, GDX, and inverse ETFs. So again, in a weighing machine, picking individual names makes a lot of sense and better sense than picking ETFs. Now, folks, we can add to this list. We can continue to add to it the differences between the voting and the weighing machine, but I think these are the most important that you need to understand and absorb and begin to apply in your own investing and trading journey. And the goal here is, of course, for you to avoid being a victim. If this thing is going to go down, you don't want to be a victim like the previous generation of donkeys that lost all of their money and they've been waiting for years till they recoup it. In the meantime, watching other investing opportunities happening, but they don't have the cash to participate. And folks, once again, in this channel, we've been ahead of the game. We've been talking about this step by step. For example, in November 10th, because a lot of folks right now would say that, yeah, we were right about a bull market. It was supposed to be a bull market. The Fed was supposed to cut rates and we were supposed to have a boom and the roaring 20s and all of that. But it all went down kaput because of the orange man. That's not true. But you hear it as an excuse from all of the fund managers and the perma pumpers on TV. They're going to come out and be called on their predictions that this is the beginning of a bull market that's going to last decades or whatever. They'll say, yeah, that was the case, but then Trump blew it all up. They're going to use him as an excuse. But I have explained to you in details, November 10th, when the same pumpers who are now going to blame Trump were saying, oh, the Trump election is the best thing that happened to the market, got to buy the market right now because the market is going to perform pretty good when Donald Trump becomes president. Now they're going to flip and say, oh, he's the reason why we went down. The kind of hypocrisy and bullshit that you see from these people all the time. But we told you in November 10th, voters told the truth about the economy. Trump cannot save it. He will wreck it. I said he's the final nail in the coffin. It's a process that's been ongoing for years now. And he's just going to be the final nail in the coffin by his policies to blow the whole thing up. But it was the inevitable. It was the destiny. It was just a matter of when. And Trump just brought it fast forward. But folks, again, December 19th, we said erasing the post-election rally. We're going to erase all of it because right now we're looking at the glass half full of the presidency soon enough. We're going to look at the glass half empty. December 29th, before the year even began, we said 2025, the return of the bear. Jan 12, I said the last time the bond market did this was before the 22 bear market. So the signals, the signs were already building up, folks. Jan 29, I said if NVIDIA does this, we have officially entered a bear market. And guess what? It was the 50 weeks moving average. The moment we lost that, it should have been clear. February 4th, we talked about Google. You look at the thumbnail, that's the S&P 500, and we showed you that's going to crash down, and we said load up the bazooka. The 23rd, I issued my stagflation portfolio, and so far the stagflation portfolio is crushing it while the rest of the market is getting crushed. The 26th, I said don't be a donkey. Don't throw the Intelligent Investor book in the garbage. You're going to need it sooner than later. If you understand this, you're ahead of 99% of investors and traders. So we've been explaining this before the whole thing began. On March 5th, I talked about copper. As the dollar continues to go down with the recession fears, a lot of folks would say that when you have recession fears, copper is not a good play, and I disagree, and I outlaid my case in the video. And I've been bullish copper since last year, added it to the portfolio last year. 9/24/2024, I issued a morning brief in my Discord, reminding everybody that Alibaba is one of my favorite picks. If it dips, you buy it. I also said that we're buying Exxon, the steel ETF. But I also said that I think copper will surge to all-time highs in no time. Gave you this chart right here for copper futures. Here's your update. We went to the highs, but now I'm saying you gotta be careful with copper. It is probably readying for a dip, but that dip will be an opportunity to buy. Just keep that in mind. On March 9th, I said warning signs of a bear market. This was a public video. We put all of the signs for everybody to see. March 26th, I had a video titled The Role of Psychology in Creating a Recession. Because right now in the media, I mean, if you read the Wall Street Journal over the weekend, there was an article that says, are we talking ourselves into a recession? Because the consumer sentiment is absolute garbage right now. But they say watch what they do, not what they say or feel. And the same comment came out of the Federal Reserve Chairman Powell. In the latest FOMC, he said, yeah, the consumer can feel bad or negative, but at the end of the day, they buy a new car. But in that video I showed you, historically speaking, when the consumer begins to turn negative, the psychology impacts spending behavior sooner than later. And I showed you the correlation. So when the consumer begins to say that I feel bad about the economy, I feel bad about job security, I feel bad about the prospects of inflation, all of these become self-fulfilling prophecies. So again, we've led everybody who's been watching this channel to this outcome way before everybody else did. And we're guiding investors and traders with extreme precision as much as we can. This week, for example, before the week even began, Monday, the 24th, I gave traders, investors the strategy. Monday all the way to Wednesday. You gotta stick with the rebound plays. We got a big rebound Monday. Tuesday a little bit. But then after, as we head to Wednesday, you want to shift strategies. You want to begin booking those rebound plays and shifting toward short plays once again. That's exactly how it happened. So again, folks, I extend the invitation for all of you to join us as a Maverick member, either here on YouTube or Patreon. The link's in the description, because soon enough, that window is going to close. Either we're going to raise the prices by triple or we're going to close the invitation altogether. Just focus on the group that we have. Now, folks, before I leave you tonight, let's do some technical analysis and then wrap it up. I want to begin with some of the indicators that we got. We begin with the dollar. This is the Dixie daily chart. The best hope for a market rebound was a rebound in the dollar. We got some of that this week, but it looks like it's going to come back down again. Let's say maybe in an inverse ABC pattern. No confirmation yet, But if it happens this way, if you see it playing out this way, what is the message by the dollar? We're going back to the recession fear mentality. And in the recession fear mentality, you're going to see the majority of stocks heading down. You're going to see the VIX going higher. You might see the stagflation portfolio doing good or outperforming, but as we see more and more fear, even some of the names in the stagflation portfolio will begin to join the market downside or underperform. So keep that in mind. I'll show you the alternatives in a minute. But the second indicator that we usually look at is the 10-year yield, or honestly any of the yields in the long end of the yield curve. But the 10 will do the job here. If we're trading above 4.3 and moving higher, that's the hope that the market is getting out of the recession fear mentality. If we pass 4.5, then we're getting back to the inflation fear mentality. So the sweet spot is between 4.3 and 4.5. It looked that way all the way throughout the week until Friday. We lost 4.3, and right now we're gapping below the 200 days moving average of the 10-year yield. So this is not looking pretty good if it continues to be that way. Along with the dollar, they're probably pointing out that the recession fear mentality has not been eradicated and will resume. And we all know why. It's Liberation Day. If the president proceeds with the tariffs, we're going to see a big flush down in the market this week. If he flip-flops, aka pushes out, and says, okay, I'm going to be lenient on the tariffs and we're going to delay it or give another extension or whatever, then the market can find a footing. Of course, there'll be a consequence that the White House will lose a lot of credibility and they're going to look extremely weak. So I don't know if they're going to do that, considering the fact that we have a president with a giant ego. Then you have the third indicator, the VIX 2-hour chart. Throughout the week, I said that we have a shift from bearish to bullish. As you can see in the MACD, we're probably going to cross the zero line, which means that we have a bullish wave now in the 2 hours of the VIX. But we got a bull flag after bull flag, and now it appears that we got another bull flag. Mr. Bear, the confirmation is at 20. VIX closes above 20. You got your confirmation that you should shift from rebound plays in the market to short plays again. And so far, it looks like the VIX is not done yet. Maybe it has another pop. It could be a big one, if indeed Liberation Day becomes reality. If we look at the 4 hours chart of the S&P 500 futures, at least at the time of the recording of this video, we pointed out on Friday's morning brief that we have a trend line, but we're forming a bear flag pattern. If we break the trend line, and then we lose 5,673, because once you break the trend line, that's going to be the destination. Once you lose that line, you gotta short the index again. Looking at the daily chart for the E-mini futures, is it looking as an inverse ABC pattern? And if it is, where can we find support next? My number is 5,528.25. Now, the good news here is the market, technically speaking, ready for a rebound again, ready to stop the pain, at least for a moment. Why? Because you plug in the Bollinger Bands, and we're close enough, so the Bollinger Bands usually will offer some support, not so much in the daily, but the weekly chart. So if we look at the weekly chart, we're below the 50 weeks moving average, so that's your bear wave confirmation. The MACD is already below zero. So we got a bear wave confirmation, but we're at the lower boundaries of the Bollinger Bands on the weekly chart. And you can go back, you're not going to see such violation for a long time or a flush in the market. It's already at the lower Bollinger Bands, not only that, but gapping below it on the weekly chart. It's not impossible. We can flush down, we can do a climactic move all the way to the downside. But the point being here is the chart is saying, Mr. President, if you back off the tariffs, I'm ready to rebound because I got support from the lower weekly Bollinger Bands. But again, if the president proceeds with the tariffs, then where can we find support if we get a flush down? Let's go back to the lows of last summer. That's going to take us down to 5,305.75 in or around that number. It could happen. It could be down about 5% plus in one shot, and then it becomes really, really oversold. Headlines become really ugly, and we see some sort of a resolution that gives us at least a temporary relief. Looking at the NASDAQ futures daily chart, uglier than the S&P already at a new low, and overnight it's going down even more. We've lost and got rejected from the trend line. We lost 20,000, the critical number. We got support at the daily Bollinger Bands, but as we've seen before, we can expand it down. The daily not as strong as the weekly. And of course, the momentum in the MACD is shifting from positive to negative again, as I'm highlighting. And it's still in the daily bear wave because it's under zero. How far low can we go if there's a flush down in the NASDAQ this week? I would say, again, the summer lows from last year, that'd be in or around 18,000. And the question right now is, where can we hide Maverick? Because if we have a flush down in the market and a big pop in the VIX, if he proceeds with their Liberation Day, then even the stagflation portfolio could get hit. Where do I hide? Well, investors have been hiding in gold futures. Gold futures have been trading at all-time highs right now. In this channel, we became bullish gold in the third quarter of 24, and I announced that I'm shifting pretty much the majority of my retirement portfolio, my pension portfolio, to the GLD, the gold ETF. Now, you might look at the chart and say, but it's overbought in the weekly. What if we have a shift, either a resolution in the trade war, or let's say investors begin to buy something like the TLT or the dollar as safety? I don't feel good about chasing gold here. Maybe you want to chase silver, because silver is not overbought. Silver futures are beginning to move, beginning to catch up with gold. So maybe that's going to be the opportunity. And of course, the psychology would say, you're not alone. A lot of folks now look at gold futures and gold ETFs and they say, okay, that I missed the boat, but not so much in silver. So let's chase that. And you might see silver outperforming gold. Here's the problem though. You look at the TLT weekly chart. It's been doing pretty good as the market went down, but not that good. It has an inverse in the shoulder pattern. It's below the 50 weeks moving average. If you begin to see that folks are shifting toward buying the TLT, aka buying bonds and bond yields flushing down big, that's not going to be good for gold. You're going to see gold flushing down too, perhaps along with silver too. Because once folks shift the mentality toward, as I said before, folks, there are layers of defense. And one layer is to stay in gold, to hide in gold or silver or copper. But once the fear begins to intensify, you got to go to another layer of protection. And here comes either the dollar or bonds. And when that happens, you see outflows out of gold and silver into bonds and the dollar. So keep an eye on those. What else can we have in the portfolio here to hedge or protect in a bear market? You can use the inverse indices. For example, we're looking at the SH, which is the inverse of the S&P 500. The weekly chart looks as a bull flag pattern. And again, if it closes consistently above the 50 weeks moving average, then this is a chart that is shifting from a bear wave to a bullish wave. Why? Because the index is shifting from a bullish to a bearish wave. So you grab the index that is inverse to it. The inverse of the NASDAQ is the SQQs. That's the most popular one at least. You can see that we have a bull flag pattern too. It is underneath the 50 weeks. It might break and close above. That's going to be a confirmation that the SQs is now becoming bullish. And your leading indicator is the IWM small caps, the Russell 2000. Usually they say that when the Russell begins to lead, that's your bullish signal that the market is going to follow next. When the Russell begins to lag and underperform, that's your signal that the market is going to follow the Russell 2000. Well, the inverse of the Russell 2000 is the TZA. Of course, you have other ETFs that you could use, but this is one of the most popular ones. It's a little more risky than, let's say, other inverse indicators in the IWM. So you have the RWM, which is more conservative. It goes 1-to-1. The TZA is 3-to-1. So if the IWM goes down 1%, TZA is going to go up by 3%. But the bottom line is the TZA is above the 50 weeks moving average. So that could be leading the SQs and the inverse indicators of the S&P 500. And it is consolidating in a bull flag pattern. So consider some of these strategies here. But folks, let's segue and conclude the show. What do we have on the economic calendar this week? We got plenty. We begin with Monday. We have the Chicago Business Barometer, PMI. Important, but not the most important piece of macro data that we got this week. Now comes Tuesday, a fresh new month, but with a lot of fears and a lot of uncertainty. We have the manufacturing PMI. This is really important because it's going to show us if manufacturers are dealing with increased costs because of tariffs and whether they're going to pass that to the end consumer or not. You got construction spending, you got ISM manufacturing, you got jobs opening. Of course, we have a speech by Fed Zombie from Richmond, Thomas Parkin. Comes Wednesday, the 2nd, we have the private payrolls from the ADP. Then we got factory orders. Another speech from Governor Zombie Adriana Kugler. Thursday, the 3rd, we got initial jobless claims. We got the trade deficit, really important. We got the services PMI and the ISM services, perhaps as important, if not more important, than the manufacturing PMIs and ISM. Then we get a speech from another Zombie Vice Chairman, Philip Jefferson. Concluding the week with Friday the 4th, we have the most important employment report, the jobs number. And of course, we're all waiting to see the damage from Doge, and that's probably going to begin to show up in this report. Then we get a speech from the big zombie himself, Powell, along with zombie Michael Barr, the governor, and another zombie governor, Christopher Waller. With that, folks, I hope you found the show informative, and maybe you learned a thing or two. And maybe you're asking yourself right now, son of a bitch, this was a good show. I learned a lot of things from it. How do I return the favor? Here's the answer. You press the like button. You subscribe to the channel. You leave us a comment in the section below, participate in the conversation, and consider joining us as a Maverick member either here on YouTube or on Patreon. Links in the description. That way you're not missing on the conversation we're having throughout the week. But with that, folks, this is all I got for you for tonight. Thank you for listening. Thank you for watching. I appreciate and love all of you. I'll be talking to you again tomorrow. Good night.
Well, Elmer, they say that with the thrill-seeking personality, what goes up must come down.